Welcome back to another installment of Mortgage Talk with Nitza and Jess. I am Danitza Nicklow, Realtor with Berkshire Hathaway HomeServices, the preferred realty in Pittsburgh, PA. And this is Jess Lyons with Lyonsgate Funding. How are you today, Jess?
I'm great. How are you?
I am great. It's almost summer break for the kids, so excited to enjoy the warm weather that you've had for a while, I'm sure, but
Yeah, let the fun begin with out of school time. The kids will be bored in 2 weeks.
Yep, they will be. So let's get some good information to you now before you're inundated with, what am I doing? What am I doing? Let's go somewhere.
Sounds
So
good.
we've been talking about the process and planning and preparation for purchasing a home. We've talked about budgeting, setting up your budget. We've talked about the, debt to income and what exactly do you qualify from an underwriting standpoint. So Jess, you want to give us a quick recap on some of those details?
Sure. So the first few conversations that we had, we were talking about, the very first step in starting the process is getting a budget together, figuring out what you feel like you can afford for your monthly payment, taxes, insurance, principal and interest, mortgage insurance, the whole payment. And, if you're looking at a condo, obviously, like your condo association fees or an HOA fee, just really getting a great idea of what you could be paying out per month. So that was the first step that we talked about a few weeks ago. The next thing we kind of touched base on the last time we talked was, okay, hey, you decided you can afford $1,500 a month. Let's look down and see if the underwriter agrees with that. So we were talking about your debt to income ratios, your housing ratio, your total overall ratio, which was like your housing payment plus any other expenses that you have. So like your car payment or student loans. So when we talked the last time, that's what we kind of went through. We were looking at, okay, if your income's this is how much you can afford for your housing ratio. This is how much you can afford for your total ratio. And that was it kind of went hand in hand with the budget, just making sure once people decide what they think they can afford, what they actually can afford from an underwriter standpoint. So that was kind of where we left off the last time. Today, I wanted to kind of talk about credit and also liabilities, because I think it kind of goes a little bit hand in hand with the whole debt to income ratio. And
Totally.
the really big thing is your budget and your payment. It's going to be tremendously impacted based off of how much you have for other debt and also what your credit looks like. So that was what I wanted to kind of talk about today.
Okay, that sounds good because I can totally relate to the idea that, people understand that they need a good credit score, but don't necessarily understand why and how it relates to changing that payment for the monthly income. So fill us in on those details.
Yes, so the credit score, depending on the type of loan, it can really have a bigger impact. If you're looking at like doing a conforming loan, which would be considered a regular conventional loan, that's where the credit score really has the biggest impact on, the payment, because they look at credit in tiers. So the highest tier is basically anything above a 740. Now, some investors will give you like an extra bonus if your credit scores over a 760. But for the most part, 740 and above is considered excellent. Um, the next credit tier is basically 739 to 720. And it just keeps going down in increments of 20 points. And there's something called a loan level price adjustment. And this is what Fannie Mae and Freddie Mac have set. And so the loan level price adjustments look at a bunch of different things, but like the main thing that they're looking at is your credit score. And depending on like how much money you're putting down and what your credit score is going to determine what the loan level price adjustment is. So the other really, really big thing, which I think makes even more of an impact than the loan level price adjustments, is the mortgage insurance. And with conventional loans, the mortgage insurance is tiered off of your credit score again. So depending on like how much money you're putting down and what your credit score is going to determine what your mortgage insurance factor is. And the higher your credit score is, the lower the mortgage insurance is going to be. There's a direct correlation with good credit and a lower amount. On the government loans, it's not really the case. The mortgage insurance is set across the board. They don't care if you have a 750 credit or if you have a 650 credit. You're paying the exact same thing. It's kind of like the government in many aspects, right? It's the same for everyone. So on FHA, the mortgage insurance actually did just decrease this year, and it went down from 0.85 to 0.55. And that's going to be the factor for most people. The only way it's going to be a little bit lower than that, Danitza, is if the people decided that they wanted to put more than 10% down on like an FHA loan, and then it reduces by like 0.5. But on the conventional loans, the difference between a credit score could mean, you know, hundreds of dollars on mortgage insurance, depending on how much of a loan they're taking out, because the factor is multiplied by whatever the loan amount is. So every property is going to have different mortgage insurance because it's going to be based off the loan amount and whatever the factor is for the credit and the down payment and everything like that. So it will fluctuate really tremendously between credit scores. So
Now, the mortgage insurance, just so everybody's clear, if they've heard about things on the news, that's PMI that people have talked about. So, you know, sometimes I'll be there and, you know, abbreviations kind of, you catch them differently, but mortgage insurance, PMI, that's what is in place so that you're paying a little bit extra in case you default on the loan, correct? So that's that insurance for the bank on their loan.
yes, it definitely just protects the bank. Unfortunately, it doesn't help the borrower anyway, but
Nope.
you won't get a loan without
It.
down unless you have that. So there are some places that will do like a mortgage insurance buyout, and sometimes it makes sense and sometimes it doesn't. There's ways to figure out what the break-even period is, but in order to do an MI buyout, you're either paying the money up front at closing, you're taking a higher interest rate. So there's a few different ways to get around monthly mortgage insurance, but once again, this is like what we've talked about before, working with somebody that can look at the whole picture and really figure out what's best for the individual borrower. That's key, because some people will just not really explain any of the options to you. They're just basically gonna kind of give you one thing and you're not going to know any better. So that's why we like to let you know, and working with the right person, you're going to find out there's a lot of different options, and it's really just a matter of picking what option you feel most comfortable with. So
yeah, and definitely recommend asking questions. If somebody's giving you information and numbers for anything, but big decisions, you want to ask the questions and fully understand. So when you're working with somebody, if you're comparing one person to another, one company, you're asking the same questions, because you don't want to be comparing apples to oranges. You want to make sure, you know, you've got the whole fruit salad before you when you're looking at it.
yes, definitely. Because I mean, the thing about mortgage insurance too, like where you were just going with that, is not, if you're doing a conventional loan, there are private mortgage insurance companies. They have different factors too. It's just like, you know, car or homeowners insurance. Different insurance companies offer different pricing. And it's the same with mortgage insurance. And we do have some investors that, because they do so much business, they get a reduced percentage, and therefore they can offer like a little bit lower on the mortgage insurance than another place. So you're right. You have to look at the entire picture. And unfortunately, if you're not a trained professional, sometimes it's really hard to know exactly what you're looking at. So it makes it a little complicated.
Yep, which is why you should always work with somebody you trust, whether it be your mortgage provider, your realtor, you know, your friend or family member who's been through it and is knowledgeable. Just because they bought a home 20 years ago doesn't mean they're knowledgeable. They might be an extremely smart person, but things change. But that level of trust to make sure you're feeling comfortable with the explanations is definitely key for all of this.
Yeah, 100%. So the other thing, other than the mortgage insurance, as we spoke about, like the conventional has the factors based off the credit. the FHA and the USDA and your VA loans, they do give adjustments too for credit scores. It's not quite as substantial as with like the conforming loan, but they do have different adjustments. So no matter what, having your credit the best you can have it looking when you're ready to make that move is going to be key. The other thing too, like we kind of started to talk about it, but like the liabilities. So one of the things that gets factored into as well, Danitza, and this is a newer change, is they're looking at people's debt to income ratio. So when they're determining on private mortgage insurance, what the debt to income ratio is, you can pay a higher mortgage insurance premium if your ratios are higher, because from like in an investor standpoint, you're more risk. The higher your debt to income is, the less likely you are to pay. It just is the given. So anything you can do to get rid of liabilities and have the least amount of things on your credit when you go to purchase is going to help you. So sometimes, and what's really crazy too, is like some people like myself, I pay off my credit card every month. However, there's times where I use it and there will be a lot on there. And the way underwriting looks at it, it's a snapshot in time. So even if you pay that payment off every month, unless you give proof to show that you pay that payment off every month, they're going to count it into your debt to income ratio. So there are ways to give the proof to show that you do pay it off every month, but it's a little bit more of a headache. So if you're going to be buying sometime in the future, I would just say try to limit yourself to using maybe like 1 or 2 cards. Don't have stuff spread out over 10 different cards. And because even if it's like $100 balance, sometimes it'll show like a $30 a month monthly payment. Most credit cards minimum payment is going to be like $25 a month, and you might only have like $200 on there. So try to, if you have accounts that have small amounts on them, you don't have to close them out. Just pay off the balance to 0. That way we're not having to count that monthly payment against you.
Yeah, I'm thinking about that. Don't close them out. Don't close
No.
them out, because that will, tank your credit score, because now you don't have that history of that card and the history of those payments. So you can freeze them. You can, put stops on them so you can't use them. Nobody else can use them. But you don't want to close the account.
Yes, no, you don't, because that would be a bad thing. It's just try to limit what you have showing on your credit. Like you just want to have less active accounts, I guess is the best way to say it. And the other thing that we were kind of like talking about earlier is try not to be transferring things back and forth. Some people play the game of where they transfer from one card to another, and that can be kind of problematic. So you just want to keep everything consistent when you're getting close to the time where you want to purchase. But this is really why it's important, even if you're thinking you're going to purchase a year down the road, this is why it's important. Reach out to a mortgage professional, talk to them way in advance, get their advice so that when you're ready, you can put your best foot forward and you're not rushing at the last second, because we'll always try to help people fix their credit up before they go to closing, but sometimes there's just not enough time to do anything.
Yep. Time is always on your side. Time will save you so much money overall. And that's definitely what we're both here to help you do. Not only save money, but make smart decisions. So anything else that, key points for today on the credit side?
No, I think it's just like I said, try to do everything in your power to get your score as high as possible. If you want advice on how to do that, I'm here and I'm happy to give advice. So feel free to call me at any time.
And all of our contact information for both of us, Jess and myself, will be below in the description. So next installment, we are looking to remind me what we're talking about next week or next time?
Yeah, next week we were going to kind of get into, the cost of a loan. So
Okay.
talking about, what's the difference between a down payment and closing cost. So that was what we're going to look at next week and kind of break down what the closing costs are so that you have an idea and kind of know what to expect when the time comes.
Okay. Well, that is what we'll be doing next week. So again, Thank you so much, Jessica, for all of the great information. This is Jess Lyons with Lyonsgate Funding, and I am Danitza Nicklow with Berkshire Hathaway Home Services, the preferred realty in Pittsburgh. We will see you next time. Have a great day.